radio for a really great future. We're talking real money.
We say lots of things over and over and over again. Not to say we're redundant and boring, but we're redundant and boring sometimes when it comes to certain things that we say over and over and over again. And one of those things is that a lot of people need help. Not that kind of help, Tom. Well, okay, you might.
You see my hand up? Yeah. Is that what the deal was?
I need help. No, not that help.
Don't get me started on that road.
You can't help it. You just can't. It's too late for you.
Yeah.
We need help. What kind of help? We need help managing our money, managing our retirement, creating an income stream, those kinds of things. When we're getting closer to using the money that we've been saving most of our life for the things that we're going to need later in life. And you'll hear a lot of people saying, well, I have a financial advisor. We've heard Paul Merriman say it. We've heard Tom Cox say it.
Yep.
Now we're hearing Christine Benz at Morningstar say it.
I believe she's like the director of financial planning at Morningstar.
The director of something money at Morningstar, yes.
Yeah. Rather important person, going to be speaking at Retire Meet 2026, which is coming up fast, March 7th, 2026. She will.
I'm so excited.
Me too, actually. So, so it's a little surprising when she writes a column about the fact that she has an advisor. She said her neighbor said, "What? You have an advisor? Don't you work in the business? Why would you need an advisor?" And the headline says, "Why I have a financial planner." And the subhead is, even dedicated do-it-yourselfers might benefit from a second opinion, which is something I do heartily agree with.
Right. Now, that's kind of interesting. I just want to dwell on that. This right there, what you just said, is one of the reasons why 15, 16 years ago, when Tom and I started our firm Vestry that became part of Appella, we really, truly decided that somebody somewhere had to give you access to that quick overview, that more responsible second opinion.
And it's helpful. We do for free. We review your portfolio and tell you here's the good, the bad, and the ugly. But she went through the reasons, and we're going to give you a few of them. And by the way, we'll also talk about people I don't think need an advisor, because from time to time people call me and go, "I just want to hire you guys as my advisor." I'm like, no, you don't need an advisor. So
yeah,
I do.
As a matter of fact, I just want to make that point again. We don't let you hire us if you don't need what we offer. Now, a lot of companies would say, "I'm going to sell you something anyway."
Yep.
No, that's wrong. That's just not right. Just because somebody comes in and says, "I want to buy your product," doesn't mean you should sell them your product.
Exactly. We'll sell them anything.
A kid walks into a gun shop and says, "I want a gun." No, you can't have a gun. You don't know what to do with it. Go away.
No. So she says she went through the key reasons she has a financial planner to see if they still hold water. And then she pointed out, she says, we've gotten a good return on the money we spent, and having a relationship with a planner has helped deliver a return that can't be quantified, peace of mind, which I think is underrated massively. But let's talk about the key reasons she pays for financial advice. Number one, she says, we wanted a second opinion on a few important decisions. I wanted a different perspective on a few topics that weren't directly in my wheelhouse, at least not at the time. And that's the reason I have one, because there's all kinds of things I don't think about that somebody else does. Second opinion and a different perspective are huge, Don.
Tax is a big part of that.
Yeah.
Because most of us don't enjoy thinking about taxes. We don't understand the convoluted ins and outs of taxes. We really don't. Most of us think about the process of rebalancing, what's good rebalancing and what's bad rebalancing, how it should be done. Should it be done by selling or should it be done with new assets? There are so many bits of minutia that an advisor deals with day in and day out that we deal with once.
Yeah. And then it's gone. But in this case, you have somebody paying attention to it, somebody who does it every day. And even I don't do it every day. I've got other people. So, and she said, did professional guidance help us move forward more confidently? Absolutely. Number two, she said they found a business model that makes sense for her situation. Now, she used hourly help, which is harder to find in the business. Obviously, she could find it. But she said paying for financial advice on an ongoing basis via an assets under management fee or some other arrangement might be the right call for some people. She decided she didn't need that, but instead they had somebody that went through all of their stuff, told them here's the things to think about and pay attention to that really helped.
And that actually makes a ton of sense, because in Christine Ben's case, she knows so much of what needs to be done. She understands the process very clearly. It's her profession. Therefore, paying somebody by the hour to fill in the blanks makes great sense. For someone else, though, for whom you're just entering retirement, you need somebody to help you glide path your portfolio. You got to rebalance. You've got to create an income stream from that, and that's an ongoing thing. That's not something you do once a year for 2 hours. That is ongoing. In that case, the fee structures start to look good if you've got a fee structure that's fair.
Yeah, and by the way, back to the assets under management fee. Most people are going to benefit from that because somebody's going to build the right portfolio, they're going to rebalance the portfolio, they're going to create income. That, I find, is one of the most difficult things in retirement for most people.
And they know, that person knows they're being paid to be, it's like a retainer for an attorney. You can pay an attorney by the hour. You can give them an annual retainer. When you give them that annual retainer, you know that, and they know that they're supposed to be looking out for your best interests all the time.
Yeah. Here's another one that I think is way underrated, according to Christine Benz. One of the reasons she hired somebody is that she says it gave us an impetus to get and stay organized. A holistic financial planner will require you to share a lot of information, statements on your accounts, tax returns, pay stubs, and so forth. If you're on the clock, as we did, it's your best interest to gather up all that documentation rather than turning over piles of disorganized paperwork. I think you have a term for isn't it hodgepodge or something?
Well, portfolios can suffer from hodgepodge.
Just met with somebody who had 7 different custodians this week. I mean,
and multiple products in every one of those custodial accounts,
exactly.
Right? Yeah.
That's
a hodgepodge.
Yeah, that's a definite. And by the way, in today's world, most investments can be moved to any custodian. Most, not all, but almost. I think Schwab accepts pretty much everything. There's sometimes some non-traded stuff that's hard to move, but they can pretty much keep all those things.
But
I
you
think
shouldn't
that's
have
underrated.
that non-traded stuff in your portfolio anyway.
Get that stuff out of there. I think that's underrated for most people. And there's another part to that too, by the way, because I just did it again. The disinterested spouse is what I have in my life. I love my wife dearly. You know that.
She's disinterested.
She just has, and we just got her a new car, and I said, here's where the money's coming from.
She was interested in that.
Yeah, but she had no interest in where the money's coming from. Like, what does that mean? Again, and that doesn't make her a bad person, just makes her somebody who's not interested. But I tell you, when she is interested, we're reworking the plan right now. Now she's dialed in again. I think that's underrated as well. Getting the other party to say, let's sit down and help me understand how this works. Big deal. Number 4, she says, we love having a succession plan. This has been one of the unexpected side benefits of working with a financial planner. Thanks to the aforementioned document share, our planning firm has current information on every financial relation my husband and I have. Bank accounts, company retirement plans, IRAs, insurance policies. That's absolutely
cool.
Huge.
Yeah. That's really big.
We find people that come to us oftentimes at the end of their life and they have a lot of stuff and they need it cleaned up because the person who's got to deal with it all is in a difficult spot. So I don't think you can overrate that.
Yeah, I think that, the more I think about that, the more I think that may be one of the biggest benefits is the inevitability of death. At least now you got somebody helping you get through that financially.
Yeah. Well, I hope they're holding my hand too. And number 5, she says, again, this is an important one for people that have been savers and investors, and they got to turn that switch. She said, a third party can give us permission to spend. I just went through my preliminary plan this week, actually, and the advisor said, you probably have enough money. You need to think about the purpose of that money. You need to think about, are you going to spend it? Are you going to give it away? These are good things and you don't have to make a decision right then. And it doesn't have to be binary, right? It could be a little of this, a little of that.
Well,
but
Tom made the decision. He's going to Hawaii again.
That's a good point. I'm spending. So it's very important things to consider, and a good advisor will help you figure those things out. And so I love this piece. But let's talk about a few of the people that don't need an advisor before I'll tell you some of the things that I think, other things that I think you should mention. Number one, and I get this call a lot. I'm 28 years old and I'm just starting to invest. I want to hire you.
Yeah, no.
And you don't need me.
No, go buy VT or AVGE or DFAW and leave
thank you.
And just do it and just leave it alone. And if
Put
you
it
need
in a Roth, get out of the way.
If you need hand holding along the way, call Talking Real Money once in a while for free.
Yep.
There you go.
And send in a question.
Yeah.
We're glad to answer them. And if it's complicated, as I said on another podcast, I'll call you. Just say, what are you trying to find out here? Number two, and this happens again as well. You're under the age of 50, you're maybe in your 40s, you're saving, you're putting money away, you're doing it properly, you're in Roth, you're in traditional, you're in brokerage, you're diversified, you're in low-cost funds. You really don't need to pay somebody to
tell
do
you
that
you're
for
doing
you.
it right.
Yeah, you really don't. I run into it, and bless you, I'm glad to hear from you, but that's not
Okay,
you're not an advisor candidate.
But how do you know you're doing it right? You see, what if you don't know you're doing it right? You're doing
you
it
get the
right,
second opinion.
but you don't know you're doing it right. So at least get that second opinion. You may not need a full-time advisor, but we all need a little help now and again. And again, that comes back to call Talking Real Money.
Fair enough.
So wait a minute. Hold on.
Yeah.
I've got this. So you either need an advisor or you need Talking Real Money. There you go. That's it. Okay. Now I understand.
Was easy.
Yeah.
Number three, the reason that you don't need an advisor, you have an income and retirement plan, right? You have good asset allocation, and you have a roadmap for the future. You don't need an advisor. You're all set. Unless you're working with somebody and you say, I really want a second opinion. That's a different matter, of course, right?
Wait a minute. If you're working with someone, then you have an advisor.
But if you want a second opinion on what they're doing, then sometimes you may need to ask another advisor to look at what they're doing. This happens all the time. People come to us from major brokerage houses, and we find out that they're sticking things like, let me think, an annuity and an IRA.
Right. You see, there you go.
Funds,
and so that's why I really like 1 and 2. I like those.
Thank you.
3 I don't like that much.
Okay. But here's a few more reasons you do need an advisor.
Okay, so we're switching from don't need now to do need.
Well, because I try to keep it honest here. So number one is to clean up the hodgepodge. Mm-hmm. Way too many of you have way too many things. It's confusing. It's expensive. And as I said before, it's going to be difficult if somebody else has to pick up the pieces.
So you need to go, in other words, you need to invest in a hodge trimmer. One of those electric hodge trimmers.
Okay. That's perfect. A hodge trimmer. Number two, you don't have a roadmap for income and spending, and you're over the age of 50. I think most people, again, should at least get a plan written, make sure they're on the right road, et cetera, et cetera. And here's another one that I think is way under considered. Most people, as we get older, and I guess the line is now, 65? We had to admit it, because that's what the U.S. government says. You need somebody who's going to be there for you for whatever day arrives. It just, things come up you need help with. As we get older, it's more complicated, and for most people, they should have an advisor in place. Could be for part of the portfolio, but they need somebody.
I hate to quibble again, but I will, just because that's what I do. Basically, you're saying for everybody over 65?
If your situation has any complexity to it and you're trying to create income for retirement, you should at least go see somebody to make sure you're doing it right.
Because here's the problem. Most fee-only advisors, almost all of them that are any good, all from a business standpoint have a minimum portfolio size. The only ones who tend not to have minimum portfolio sizes are those who take commissions. So that's the problem. You're going to end up relegating a lot of people with under $500,000 in assets to the non-fiduciary brokers out there and insurance agents who are going to sell them garbage. I wish I knew a way around that.
I think that's a concern. Yeah,
I do. I wish I knew a way around that. We've struggled. We in the past with our firm kept trying to find ways to make economic sense to manage smaller clients. And guess what? We're pretty smart. We couldn't figure out a way to do it.
Well, we do have one now. It's called Ascent, and we are helping people with smaller accounts. So, but you don't get the full planning suite.
Yeah, you don't get the full thing, but at least you do get something.
Mm-hmm. So, but you're right. That's a weakness, but it wouldn't be the reason necessarily I wouldn't call somebody to try to get some help. So, I think that's fair.
I guess maybe my point is more beware.
Yeah.
At that dollar level, what kind of help you might be getting yourself into. You have to be even more cautious, I think, at smaller account sizes. All right. That's good stuff. Got questions?
Oh, I do. Always.
From the people who don't need an advisor? We need their questions.
We need their questions.
Number two.
And I think this one right here is right along those lines from Salem, Oregon. It's Richard. He writes, I'd like to add more small cap exposure. So what he's talking about here is owning more small companies, right? There are three, and by the way, I'm hoping we'll talk about soon, but Larry Swedrow just wrote a piece about how actually small cap value as an asset class has outperformed large growth over the last 5 years.
How did that
Wouldn't
happen?
have believed it. It just snuck up on you. But
exactly, and that's another one of these lessons that we try to impart is this stuff sneaks up on you. It doesn't signal you in advance. There wasn't an alarm that went off and went, oh, look, my alarm's going off. It's time to invest in small cap value. Nobody told you.
No, you're already invested in small cap value. He says he'd like to add more small cap value. 3 funds in order of preference that I'm looking at. AVUV, which is the Avantis U.S. Small Cap Value ETF, which we like. SLYV, which I believe is a Schwab product, but it's also small cap value. And then Dimensional's DFSV. Which would you prefer and why? AVUV and DFSV seem very similar to me and are rules-based. Yeah. And SLYV is a passive fund that follows an index. So I took it upon myself to kind of look at how those
I was going to say, I hope somebody looked
years.
at those because I haven't yet.
Because I was kind of curious. I was not familiar with SLYV, which is the S&P 600. So in this year to date, as the time of this recording, in early
That's not
October,
Schwab, by the way. That's the spider. Just so
pardon me. You're what a dork. It's up 2.7%. Last year made 7.2. 2023 14.8. Sound pretty good, right? Okay.
Mm-hmm. Great expense ratio at 0.15. It's very good.
Yeah, very inexpensive. Then the Dimensional DFSV. That is up 4.2% year to date, made about the same last year as SLYV at 7.1%. And then in 2023 made a whopping 19.2%. And one of our favorites for a very long time, favor the fund family, and we really like this fund, AVUV. It's up 4.0% this year. Last year, 9.2% and 22.8% in 2023, leading the pack for all 3 of those
I thought
funds.
we weren't supposed to compare returns.
I know, and it's a very short period of time. But it does point out the fact that AVUV and DFSV have, as he said, rules-based, but they're going to own more smaller companies and they're going to own more value, deeply discounted value than SLYV. So this is a fork in the road because one is an index. It's a little cheaper than the other 2 products, right? Mm-hmm. But the other 2 products, I would advocate due to the fact that that they are owning more of those types of companies that have provided a greater return over a long period of time. That's how I'd put it.
Of the 2, it's very interesting. And I'm not picking one necessarily, but of the 2, the Dimensional Small Cap Value ETF skews a little bit more value-oriented than the Avantis, whereas the Avantis is smaller stocks. So they skew more small. So if you want more small, you go with Avantis. If you want more value, you go with DFA. If you want to split the difference on expense ratios, the index is 0.15% per year.
Yep.
Dimensional is twice that at 0.3%, and Avantis is 0.25%.
Boy, that's like splitting the atom or something there. I mean, that's really getting down to the fine.
It really is.
Yeah.
And the other thing is that in the dimensional and the Avantis, you actually get, this is weird because you're not buying the index because it's only a 600 stock index. You're getting better diversification. Because
more stocks, because 600,
the dimensional fund has over 1,000 stocks.
And the
Avantis has about 800, 780.
Yeah, a little less. Yeah, they're going to be tighter on that. So honestly, if I was picking, Richard, I'd pick either the dimensional product or the Avantis product. Either way, I think you're going to be fine.
Yeah, I would too. I would go with one of those. And again, we don't get any kind of compensation whatsoever from either of those firms. We get nothing from Vanguard. We get nothing from we don't get anything. The only compensation we get is from our employment with Appella. That's our compensation.
Yeah.
That's it.
Richard writes us from Evansville, Wisconsin. I'm 77. My wife is 73. Total net Social Security and pensions is $6,000 a month. Social Security says only about $1,100. I'm a CSRS retiree. That's why Social Security is low. I pass it on. The pension continues at 55%. So he has a survivor benefit of 55% or $4,400 for his wife.
Okay.
This counts the health care premiums being taken out. As of now, health insurance is excellent. Pays everything but a small portion of prescriptions. He walks through his portfolio a little bit. $275,000 in cash, CDs, and a brokerage account. Expenses are $5,700 a month. House and car paid for. Car is 2025, so don't need a new one. No debt. Funerals are already paid for. Long-term care policy that pays $8,500 a month for 2 years if needed. Will we have enough to last until 90-ish? $8,500 a month for an LTC policy.
Wow,
that's
a good policy.
Yeah. So everything's paid for, or right down to putting you in the ground. But I got to say, it looks pretty good to me. I don't have a lot of other. My only worry is liquidity, because if something big came along.
275.
275. So if you really are living
decent
on
amount
the
of liquidity. I mean, think about that. That's 4 years. 4 years of spending.
Good point. Good point. If everything, and his wife's going to get $4,400 a month plus her Social Security, so she can probably pay the bills because it won't be as expensive with just one person instead of two.
Well, it won't be a lot cheaper with one instead of two. Really?
I don't know. My house.
Your experience though is not the norm.
Unique. Let's just say that. I hope she doesn't listen to this, but we know she won't anyway, so we're okay. So the thing is, hope somebody to come at retirement. I just heard about you. You're a crazy spender, huh?
Yeah.
Please don't do that. Don't do that. Because she's not a crazy spender. She's just a spender. So yeah, this is probably okay. Sure. I mean, I guess the only thing I didn't find out is the value of your house, and if you had to, as an emergency, you could consider doing a reverse mortgage. If you had to have money out of it at some point, that would be a possibility. But yeah, this looks fine.
It looks
fine.
All
a fixed income.
There's lots of liquidity, and really that's what you need when you're in you're getting into your late 70s, early 80s. That liquidity is really crucial because that's but you've got the health. Here's the thing: you don't even need the liquidity for the reason most of us do, and that's long-term care, because you got most of that taken care of with the policy.
Yeah, you're all set there. So the
policy
that does help having
you
this policy.
Can't get anymore.
No, that's at.
I mean, the policies I've been looking at lately have like $150,000 lifetime cap, pay $100 a day. $100 a day.
Not going to cover much.
Not going to cover much.
No.
They're just not very good because, well, there's a reason why they're not very good. Insurance companies are in the business of making money for their shareholders, not their policyholders.
I'm just going to be nice to my kids and hope that works out.
It's not a good strategy. Trust me, I know your kids. It hasn't worked. It won't work.
It won't work. One kid so excited to get to California that all the applications are already done early. So can't wait to.
I'm out of the house
here soon. Yeah, bye. So, wow, fun times.
You're going to do empty nesting part 2.
I know. No, actually, technically, be the first time I've been an empty nester since 1985. So we're going back a few years.
Oh, yeah, I guess that is right.
There was overlap there.
There was overlap. You did have young enough that you had overlap.
Yeah, I know. So it's going to be an odd situation. I guess I'll be watching a lot more television or something. So making dinner less.
You're not going to do soccer reffing now that you've killed yourself.
I know. Well, hopefully they fix the knee and I'm back out there, but we'll see. So anyway, thank you. Great questions. Thank you. Great calls to us and to ask for our help. We'll do it. We'll look at everything free. I just had a nice chat with someone in your old state, Don, in Colorado. Bronco fan, sadly. But so give us, send it in. We're glad
better
to
than being a Raiders fan.
Oh, that goes without saying. So misery, misery, misery. So go to talkingrealmoney.com and ask for help. We're there.
Apparently that black hole they play in sucked all the life out of the team.
The black hole literally sucked in the entire, any talent you had.
It just got sucked into the blackness.
That's sad.
Maybe next time they'll make it a nice, cheery puce.
Well, they only spent like $1.3 billion on the place or something. So
that was mostly in black paint.
Yeah, they used up all
the black paint in all the black paint in Nevada, and they had to get some. They had to import some from California.
Imagine how hot the outside of that gets too when it's warm.
Thanks for being with us, a part of us, a part of our show, a part of our little Talking Real Money family. If you have questions, go to talkingrealmoney.com. Send them in on the contact form. If you want to meet with somebody like Tom or one of our other advisors at Apella Wealth, we will provide you one for a brief period of time for nothing, without any obligation or high-pressure sales pitch. Promise. Just go to talkingrealmoney.com, click on Meet an Advisor. Otherwise, we're really going to ask that you tell people about this program. Because in the brief time we have remaining, we'd like to help as many Americans as possible. And we can't do it without your help. So tell a friend.
This isn't a pledge drive. This is reminding me of my PBS days or something.
Operators are standing by.
I guess. Answer now. Get your credit card ready.
To take your call. We call them your friends, but call them and say, I'm just calling to share the good word. Okay, the good 3 words. Talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Apella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Apella Wealth, a fee-only registered investment advisor. Please see Apella Wealth's ADV Part 2A on our website for information regarding Apella's fees and services. Apella Capital, LLC, DBA Apella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Apella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.